How this guy could be chief economist of the IMF, not understand this stuff, God alone knows. So in modern universities, it's a kind of the sort of cancel culture, that you just suppress these references to what in fact, it really, ladies and gentlemen, it is the correct theory. It's a right theory. And it's, to me, been a revelation. I'm in a shock. It's just appalling. Look, if you're running a company, what's the most important piece of information each week? The bank statement, for God's sake.
My name's Tom Clougherty. I'm the Executive Director here at the IEA, and I'll be chairing proceedings tonight. Our subject tonight is Professor Tim Congdon's new IEA book, when it came out in June, The Quantity Theory of Money, a New Restatement. I think this is an important book, and we at the IEA were absolutely delighted to publish it. Tim, of course, is no stranger to the IEA. He was a regular columnist for Economic Affairs, our academic journal, as well as for EA magazine. Sadly now defunct, but was a magazine targeted at students. He's written for Economic Affairs, just contributing academic articles several times as well. Tim is also a former trustee of the IEA, so he knows this building and its contents fairly well. Tim, of course, is a leading proponent of monetarism, especially broad money monetarism, in which field he is perhaps the preeminent voice in the world, and certainly in the UK. Tim began his career as a journalist with The Times. He advised the Thatcher and Major governments on economic matters. He established Lombard Street Research, and he's published several other books, including a very good collection of his previous work, Money in a Free Society. More recently, Tim is the founder and chair of the International Institute, or the Institute for International Monetary Research, and their monthly updates. So, Tim, with that, why don't I hand it over to you?
What this is about is actually deeply, deeply shocking. What it's about really is the complete failure of the economics profession to understand how the inflation surge of the early 2020s was caused. I basically, by myself, in March and April of 2020, saying there's going to be an inflation surge. And I was using a theory I've used for 30, 40 years. And in a sense, it was rather frustrating. In another sense, I can gloat. But what's shocking about this is that it really is true that the great majority of the world's top economists nowadays don't have a clue about the cause of inflation. They haven't got a clue. And if you just go away from this evening with that message, I'm happy, because that's what I really want to get over to you. All right. So I'm told if I do this, it'll come on. All right. Now then, this is... I live in Gloucestershire, middle of Gloucestershire, darkest Gloucestershire. But every Friday, on the Federal Reserve website, there is data on the bank deposits of the American banking system. Every Friday, and I check it. What they showed in late March and early April 2020 was that bank deposits, which are the bulk of the quantity of money, were rising at that time. One fortnight, they went up by 5%. That's an annualized rate of 250%. All right? And then this carried on for some weeks after, not at that same degree. So it's clear that there was something very major happening for quantity of money, broad money. And then, to my mind, this meant obviously going to be inflation. This guy was the chief economist at the IMF between 2008 and 2015, Olivier Blanchard, and he said this is May 2020 that, this is the end of the challenge for monetary fiscal policy that's likely to be over the next few years to sustain demand and avoid deflation rather than the reverse. This is when the quantity of money in the USA was surging by incredible amounts. All right. And it's not just this guy. This chap here was vice chair of the Federal Reserve, in effect, the Federal Reserve chief economist. I'm not making this up. This, again, is May 2020. The COVID-19 contagion shock will be disinflationary. This is when the quantity of money had gone up, at these fantastic rates for some weeks. It will be disinflationary not just over the next few months, but over the next few years. And then in 2022 and 2023, we had the highest inflation in most countries and developed countries for 40 years. It's these guys who are Now, look, myself and Juan Castaneda, who's here, got this right. And can I just again bless the IEA because you published something by us in June of that year saying inflation the next threat. So we got it right. Okay, so that's really what this evening's about, in a way, what this book is about. I'll go very quickly here. The evidence in favor of a monetary theory of inflation is, it's not just correct and persuasive, it's just overwhelming. All right. How this guy can be chief economist of the IMF, not understand this stuff, God alone knows. This is the data from the IMF, by the way, IMF database, showing you the growth rates. There's the growth rates of broad money, and then of nominal GDP, mostly from 1980 to 22, but for some countries for a shorter period. Obviously, for the Eurozone, the Chinese start in the late 90s, it's from 95, and so on. Now then, so you see that the top is Japan, lowest money growth rate, lowest growth rate nominal GDP. Then at the bottom is Argentina with 73.6% compound growth rate of broad money, and that's inflation rate 72.2. So let's just do a regression. I know the R squared. This is a measure of how good this rate is. 0.995. I mean, my God, the T statistic is almost 60. This relationship is utterly overwhelming. And I just showed you that quote from this chap, Olivier Blanchard. This is the United States. You see, I knew what's happening with money numbers. This is a weekly press release from the Federal Reserve. Okay, why do they publish it? They probably didn't look at it. I was middle Austria looking at it and checking what's going on. And this is the number, this is the growth rates, again, broad money, the nominal GDP for the last, what is it? It's 60 years. The 7.3, 6.4. They're clearly related. Not magic, not totally, but overwhelming. And you saw what Richard Clarida said. It was very high up in the okay. So now, having said all that, my approach to this subject is a little bit distinctive, and I have battles and debates. I have battles and debates in this room, by the way, with various people over the decades, and I'm very much focused on all bank deposits, all money balances. Look, if you're running a company, what's the most important piece of information each week? The bank statement, for God's sake. If you're trying to run a portfolio, you've got to judge the amount of cash you have against how much you actually really invest. If you think the world's going to pot, you don't have much invested in cash, etc. So the bank deposit is absolutely fundamental to decisions in business and finance, obviously. Anyway, so I won't go through this now because I haven't got time, but you see, this is I annualized the growth in the last 3 months. Okay? So through March, April, May, June of 2020, we had this huge surge of money in the USA, which you could pick up the information every week. And so the 1 month of April, by the way, I could spot what was going on early in April. The US measure went up by 7.5% in 1 month, annualizing at 135%. Latin America. This was published in the Institute's research. I'm sure one can remember it. And one or two people did actually ask, wow, this is telling you very clearly there's a problem coming up with inflation unless this is cancelled very quickly. So anyway, all I did really at that time, this is all, by the way, in, I guess, chapter 7 of this book. This is the quantification of the announcements made by the Federal Reserve and the US Treasury and the impact on broad money. I said it would rise by about, given what they were saying, by say 30% in a couple of years. In fact, it was 31%, annualizing about 16, 17, 18% kind of number. You could work out from the announcements that's what it meant. And then plainly, since this was much higher than had been previously been recorded, like 4% for most of the previous decade, that meant that there's going to be a surge in nominal GDP, a surge in inflation, and so on. Not very difficult, but anyway. And can I also just say, I really was in the middle of class to look at these numbers. I'm doing things for you and other people, but this was one of the some inflation calls, some calls economists make in the city, whatever, are hard. You're not confident you're going to be right. This one was an absolute cinch. I have never seen, but the fact that all these people in Harvard and Ivy League universities and the IMF, and God. So thank you very much for publishing us, and it's very nice.
I like that slide.
I have had lots of debates over my decades working in this subject. What has gone wrong in, really the 21st century? Now, can I just say I've had lots of debates with other monetarists. I'm not going through that now, but there's been lots of them, and I've seen some in this room. What's happened very much in the 21st century is that partly because of the problems, the debates about monetarism and some of the difficulties in the subject, the central banks have moved to favour a kind of macroeconomics called New Keynesianism, which is embodied in a mere three equations. And there is no reference in this kind of macroeconomics to money and banks at all. I'm not making that up. The only equation determining aggregate demand is something called the IS curve, which goes back, in fact, to something invented in the late 1930s, in which aggregate demand depends upon the central bank interest rate. And I regard this as complete rubbish, frankly, but Hugh Pill, in a speech, Hugh Pill is the chief economist of the Bank of England, at a speech in 2022, described this stuff as iconic, or something like canonical, sorry. Anyway, and then there's another set of ideas that what matters is credit, not money. Typical Bernanke pushes this. If you compare all the transactions that are done through the banking system, there's payments made by money, and there's new bank loans, okay? In most countries, transactions are hundreds of times larger than new bank lending. New bank lending matters because it creates money, and that's the only reason it matters. Otherwise, it's very minor, it's not an important part of the economy, and I'm afraid all this stuff, again, is wrong, but it's very prominent at the moment, largely because of Bernanke's influence, and other people too, that Bernanke's got. And Bernanke, of course, then did this review of the Bank of England's forecasting record in the last year or two. And just to finish this off, so I really do mean this, that none of the currently fashionable schools of macroeconomic thought has a straightforward, empirically persuasive, well-integrated approach to understanding the determination of national income and wealth. I regard a lot of this stuff, rational expectations and real business cycle theory, as just a lot of nonsense. And I'm very much in favour of theory that goes back hundreds of years, that was restated by Milton Friedman in 1956. The title of the book comes really from Friedman's, he had an article in introduction to a book, The Quantitative Theory of Money, a Restatement, and this is a new restatement, about 70 years later, following it since my whole career I've been gone through. So there we are. I think that introduces this.
Very good.
Anything else I want to say? Is trying to understand this. Part of it is that quantitative theory does have a kind of political, it tends to get linked to conservatism and right-wing. I think that's understandable, but I won't go into that now. And so in modern universities, it's a kind of the sort of cancel culture, that you just suppress these references to what in fact, it really, ladies and gentlemen, it is the correct theory. It's a right theory. And it's, to me, been a revelation. I'm in a shock. It's just appalling, And can I just say before I finish finally that this guy's got, I'm very grateful to him and so on, but I have some differences of view. Andrew Bailey has just brought out some reflections on this period, and he says not a thing about my critique or anything else. And by the way, the Bernanke Review again says nothing whatever about my critique of the Bank of England, the fact I got it right, and so on.
Mm-hmm. It's telling. Tim, thank you. I wonder if we can talk just a little bit more, or ask you to expand on the mainstream macroeconomic profession,
right,
and why they seem to get it so wrong. And you mentioned three-equation Keynesian,
yes,
new Keynesianism.
Yeah.
and the IS function in your remarks just then. I mean, you go into that in a bit of detail in the book, both its roots in Keynes's general theory and its perhaps perversion afterwards. I mean, can you explain? It's always useful to try and get into the mindset of the people who hold the alternative view. What were they thinking and why when they said the COVID would be disinflationary?
As far as Clougherty is concerned, I think it's very much that they have this view of the world where they don't look at money, they don't look at banks, okay? They may look at credit, but that's just terribly disorganized. So how are prices and wages determined? Well, prices are determined by demand, in the goods market, if you wish, and wages are determined in the labor market. And prices, in many cases, are just a markup on labor costs. So what's crucial is the labor market. Now, April, May, June 2020, in the USA, millions of people lost their jobs. And the jump in unemployment in, I think, April was faster than anything before. It was faster even than in the Great Depression. So if you look at it that way, you can see how Clougherty reached his conclusion. You know, all he's got is that they don't look at money. So they here again, we didn't have quite the same rise in unemployment, but we had this view that there's going to be some years of so there's that in terms of I could talk for 10 minutes, Tom. What I would say, and I think this is just to be, the Samuelson textbook has done a huge amount of damage. And indeed, it does come from the general theory. The general theory isn't general at all. What it's about is an economy where when you're thinking about how much money you have, you compare that with a bond portfolio. And a chap called Dennis Robertson then mocked this as the bursar's theory of interest rates. It's like a college bursar, you see. Look, real world, you're running a business. There's a bank account. You've got your costs, your material costs, you've got your revenue coming in, you've got money against bonds. What are you talking about? All of us are running a bank account against the income coming in, expenditure going up. And every company, as I said, the key bit of information each year is the bank statement. When you're thinking about your portfolio, is it money against bonds or money against equities, money against a house? You know, you build up a deposit in a bank account or a building society to buy a house. So anyway, what Keynes did was to have this, the central relationship is between change in quantity of money, change in the rate of interest, and then the effect of change rate of interest on aggregate demand. That is the IS function. That is the only bit that's determining aggregate demand in this interest rate only macroeconomics, the new Keynesian stuff. And there was, I mentioned it in here, a statement by a lady called Professor Tenreyro, she's at the LSE, where she said there is no money channel. The only channel by which monetary policy works is through bond yields and interest rates. What world was she living in? Okay, so you know, so it's as deep, it's as fundamental as that. In a sense, I don't really. Maybe Keynes was brilliant, and he oversold the interest rate theory in the general theory. It then comes through Samuelson, and then there's a whole mass of rubbish that's then followed it. And in the 21st century, this stuff has taken off.
Interesting. And I mean, I think a point you make in the book quite powerfully is that while on the one hand you can show quantity of money versus nominal GDP over time and see that extraordinarily close relationship.
But I just wonder, I chose the evidence. Oh, yeah. But there are more difficult periods. I don't dispute that. So anyway, sorry.
Well, but no, the counterpoint is if you try and do the same thing with interest rates, you find seemingly no relationship whatsoever.
Well, you see, the IS function is supposed to work, but because of this, course, it is what central banks do in a sense. Interest rate goes up, so nominal GDP goes down. and you just do a regression over, say, 30, 40 years of nominal GDP change in a level of interest rates, I won't go through the problem, but the essentially it's the other way around. When you get rapid growth of nominal GDP, when you have high interest rates, and that's tied up with, of course, inflation, you then get into a whole mass of things which I can't go through now, Tom. Oh. All I would say is that for my, for the profession of economist to be totally dominated by this stuff, hopeless.
And I suppose one of the crucial points is that if your sole focus is on interest rates, and your monetary framework doesn't include money, it makes it impossible, for what you make in the book, to calibrate the impact of asset sales and purchases. And that actually, I mean, certainly over COVID, but to a degree since the financial crisis, has been the main way they've been conducting monetary policy.
Okay, exactly. In broad money monetarism, there are purchases and sales of so many hundreds of billions of government securities with this effect on broad money. And then there'll be a relationship between the change in broad money and the change in nominal GDP. All right? So you have a framework that relatively easily gives you answers to the question, how should we quantify the effects of QE, and how should we adjust policy if we're going to use this instrument? What kind of quantities should we be using? But then you must understand that there are some monetarists who don't use broad money. And in the USA, broad money is typically, I think at the moment, let's say 3 or 4 times the size of M1. It's a much higher multiple of the monetary base. For those economists, supposedly monetarists, who are looking at monetary base at M1, they get the wrong answer. So it's very important. That's the point about broad money monetarism. For the people who've got the 3-equation New Keynesianism, they haven't got an answer at all. Can I just say on this front that the Bernanke review of the Bank of England, its performance in this period, its forecasting and so on, look, it's not a secret that the main criticism from me and other people who've taken this up is that the asset purchases in 2020 were too large. All right? That's what caused the excessive money growth. There are other things too, but that was the most important thing. In the Bernanke review, there is nothing, apart from one sentence saying they don't refer to it, there is nothing about that at all. All right?
It's pretty extraordinary. So I'm going to come back to the how you define money question in a moment, but a couple of other things first. I mean, despite your obvious differences with Keynesianism as it's been practiced, you reference in the book that Robert Skidelsky, Keynes' biographer, has referred to you as a Keynesian monetarist.
Yeah, sure.
And you say you welcome the label.
Absolutely, that's fine. You see, Keynes was a comedian. He was lots of different positions. He's always changing his mind. And he wrote, before the General Theory, he wrote 2 books, 2 very important books, one called The Tract on Monetary Reform, 1923, which in fact, this is curious, he advocated control of the growth of the credit of the main clearing banks. What he really meant, because at that time the credit and bank deposits were used interchangeably, it meant control of the growth of the bank deposits of the big London clearing banks. Monetarist. He wanted that, not the gold standard. That was the point of the book. He wanted to manage currency where control of the quantity of money is absolutely central. All right? Then he wrote, by the way, that was a combined couple of articles in The Guardian at the time. Then the 1930 treatise on money, in my view, is a much better book than the General Theory. And General Theory is, in some sense, better organized. People say the treatise is less than the sum of its parts. I don't agree with that. I think it's a much better book. And I'm very much in favor of, and as I say, I think, Keynes is a great economist. The real problem was Samuelson. You see, someone like Krugman. Krugman has said, Krugman, by the way, people don't know, he's the world's most influential economist in the world. He has a column in the New York Times and regarded as the most influential economist in the world. He's very open but his economics is really from Samuelson. It's very standard macroeconomics. He's not a socialist. He believes in the market in that sense. But then he believes in fiscal policy, Keynesian macroeconomics, coming from Samuelson. And he says Samuelson is what made him. So you see, okay? All right.
So from Keynes to Milton Friedman, you talked about the title of the book. It's a deliberate echo of Milton Friedman's 1956 Restatement. And you describe it as a response to the many challenges faced by the quantity theory in the 7 decades since Milton Friedman wrote. In your view, what are some of those challenges? Where has monetarism fallen down?
Okay.
We can probably think of the post-financial crisis era, the latter half of the 1980s in Britain, but not to put words in your mouth. What do you think the big failings of monetarism as it's seen
there's
externally?
No doubt that the critical period was the early 80s. Between 1976 and 1985, when broad money targets were scrapped, in a way, the conduct of policy was as if, my approach was correct. This really came in a way from the IMF, not just from the IMF, but the IMF at that time, in late 76, was imposing a program on Britain. And the program worked on the basis that monetarism was correct. And all I was doing was, I was a very young man, but I was working in the city and I wrote a lot of the time. And it was really just saying that we should have the IMF discipline all the time, But that was when the money target existed. Very important to Thatcher's program to get inflation down. Inflation did come down. But in the 1970s, you had high inflation, low interest rates, people getting out of money, so the velocity of circulation was rising. And then in the 80s, there was a number of changes. Much higher interest rates. We had 17% minimum lending rate, it was then called bank rate. We had high real interest rates for much of the 80s. And so people held more money balances relative to their spending. The velocity fell. So what critics said is that, you said that the velocity could do this, it's done something utterly different. The targets are based on, if you wish, a false prospectus. And it was a very difficult time in terms of the public debate. Unemployment went up. It didn't go up just because of monetary policy, but it was blamed by the... And it's very important to understand in all of this that most British economists did not like, the monetarist approach. So there was the letter from 364 economists protesting against the 1981 budget. They included many chief economic advisors to previous governments and things like that. So that the line that was being taken by Thatcher and her government was in a sense very heretical, very much against what universities believed. And that was by far the most difficult period, I think, for monetarism, because at the end, the broad money targets were scrapped. Inflation did come down. They did achieve that, but they were scrapped. And then we had another boom-bust cycle in the late 1980s. There's much more I could say, but that, I think, was the most important problem.
And then I suppose the issue around the financial crisis, and you had large waves of quantitative easing, and some self-described monetarists predicted quite loudly that this would result in massive inflation.
Yeah.
It seems to me when that didn't happen, monetarism writ large was kind of discredited.
I think that's correct.
And that may have fed into its absence from the debate, with notable exceptions for the pandemic.
This is just me talking, and I think this is correct, basically. The banking system, banks around the Western world had problems financing their balance sheets in summer 2007, going on for some time into 2008. The way that some central banks, most of the central banks regulators then reacted, was that the problem is that the banks don't trust each other. They must have much more capital. So in October 2008, the Basel III capital regime was introduced to the banks. you must operate your businesses with much higher ratios of capital to assets. In fact, the capital asset ratio, it was increased by roughly about 60-70%. Suppose you're running a bank and you're suddenly told you must need 60 or 70% more capital against your risk assets. What do? You start reducing your risk assets. This was supposed to be the answer to the problem when we had a deflation. Basel III rules intensified the recession. All right? Very far from sorting the problem out, they made it much worse. Now, probably seeing me prancing around this evening, understand better why I have no time for these people. They haven't a clue what they're doing. They didn't understand the faintest thing about. They didn't appreciate you raise capital asset ratios in the banking system. This is very deflationary. I then had to kind of do a somersault. From spending all my previous career saying we must reduce monetary growth with God, no, we must increase the amount of money, chuck it at the economy, all right? So I actually recommended, I was one of the people advocating QE in these circumstances, but actually we should have a huge dollar, first of all, see if it works, try another one on top of that, and that's what they did, mercifully. Because if they hadn't done that, the quantity of money was going to collapse. Now, I hope that's understood. Some of it's probably quite difficult, I don't know. This is not the standard view, all right? This, by the way, the great financial wasn't caused by capitalism. The problem was the way the regulators and central bankers dealt with it. The introduction of Basel III and IRA, right? So QE was needed to offset that. Now, this is all about banking. It's all about the size of bank balance sheets. It's all about actually bank deposits, broad money. You get the monetarists, monetary-based monetarists, the narrow money people. Interest rates collapsed while this is going on. Interest rates collapse. Okay, then there's then no point holding anything in an interest-bearing deposit, so people just move money into current accounts, sight deposits, and so on, which rise rapidly. M1 was rising rapidly in 2009 and 2010. And those economists look at M1, not me. Those look at M1, inflation. So you get, or indeed the monetary base, then you get this, the open letter to Ben Bernanke from the Hoover Institution people and other monetarists. And then, of course, they're completely wrong. Look at lending to the private sector affected by the change in capital rules. Look at bank deposits, all of them, please. Broad money, always. If there hadn't been QE, broad money was going to be falling by about 1% a month, as in the US Great Depression. All right? But this is the importance of always looking at broad money.
All right. Well, I think that brings me to my next set of questions. And actually, maybe I should have started here, but I'd like to go through just with a few short questions, in a sense, each step of your theory as it's presented in the book,
Okay.
And just try and really boil it down to the simple essentials. So the first question is, and you were just alluding to it, for your purposes, what is money?
Okay. It's anything that can be used to make payments on a regular basis at low cost. One of the problems with this definition is that time deposits, in theory, or deposit accounts in Britain, you're supposed to give a period of notice to use the money. The difficulty with using narrow money is that it can be changed by a transfer between different types of money balance. And these transfers have no effect on the economy. It's only with an all-inclusive measure of money, a broadly defined measure of money, that if it's too large or too small, it then affects spending on goods and services, it affects portfolios. Because it's all-inclusive, it cannot be affected by compositional changes. All right? That's the critical point. I'm sorry, this stuff is quite hard, and but anyway, that is why one must always look at broad money. The other problem is there are things just outside broad money, which may not be exactly money, but liquid assets, if you wish. And there's always a kind of problem of where you draw the boundary, where you put the boundary. But I think it's just going to summarize this. In most societies, the banking system specializes in payments. And therefore, what you'd expect is that the boundary will be somewhere near, where the banking system has liabilities. That is going to be somewhere near there, even if one admits that there are liquid things that are not money.
So, how is broad money created and destroyed?
Okay, it's essentially the extension of credit by the banking system. It's very shocking that all a bank has to do to create money is to, I go to my bank, I say I want an overdraft, £50,000. They put £50,000 in the loan account. That's on the asset side of the balance sheet. £50,000 on the other side, that's a deposit, which I can spend. I spend the deposit goes somewhere else, goes to another account beyond that. It just keeps on going round and round in the economy. Yeah. And it's, in a sense, that simple. But the bank, I write my check to somebody who then uses that check, goes to the bank and takes £50,000 out in notes. Then the bank is short of cash. All right? And then it's every day, the Treasury Parkers bank, the banks have to make sure that they've got balance at the central bank. All right? They've got that constraint on them, a liquidity constraint, cash constraint, and they've also got a capital constraint. The central bank is not constrained at all. The central bank can create money out of thin air ad infinitum. And that's why, in many countries, a control on the central bank lending to government is restricted. It's constitutionally restricted.
So a supplementary question, maybe a slight diversion there, but can government borrowing affect the quantity of money?
Absolutely. If the government goes to, I'll just do two illustrations here. The government has a budget deficit because they're high spending on the education budget. Then it can go to the central bank. It has a new deposit created for itself by the central bank. And then the deposit is used to pay the teachers' salaries. It goes into the teachers' bank account, etc. So it's like that, all right? The monetization of a budget deficit is a very important part of and therefore the finance ministry and the central bank must always be working together. Okay, they certainly were, by the way, in 2020. And one of the conjectures I made was that the monetization of the deficit would be in this period for the next 6 months to a year would be between $100 billion, $150 billion. I then just last week checked it. In fact, it was more than $150 billion in the year from May 2020. It was, in that period, that year was about $2,000 billion. So monetization of the deficit was a large part of the story. One of the beauties of QE is that what happens there is that the government borrows from the central bank, which sounds terrible. The government or the central bank itself borrows the commercial banking system. Then the way it actually worked in Britain was the central bank goes to the clearing banks or the big banks, says, they tells them here's some cash reserves. The banks then give the Bank of England a deposit, and the Bank of England then spends a deposit buying up gilts. Okay. Now you might say that the increase in cash reserves and increase in public sector indebtedness, and so it is. But actually, the purchase of the Treasury bill of the government securities takes that debt out of the private sector hands. So the beauty of QE is that it increases the quantity of money without changing the debt. Okay. So if you're worried about the sustainability of public debt, which I certainly am, then QE is quite a nice instrument. Okay.
Interesting. So I think one of the...
I'm sorry, this stuff is very hard. All right. I don't...
Well, you don't want to spoil the book. They've got to read it, so I can't tell them everything.
Some of the stuff is hard.
Yeah. Okay. So I think one of the really interesting contributions this book makes is the detail you go into about the transmission mechanism.
Yeah.
From changes in the quantity of money to macroeconomic outcomes like nominal income, inflation, and so on. Now, can you talk us through that transmission mechanism?
Yeah.
I think this, in a way, when I was reading this book, that was the one thing I had to really get my head around. And this is where it differs, I think, the most from the sort of standard theory of exchange simplified monetarism.
Okay, all right. I think probably the simplest way to tell this story is whatever reason, I think Friedman used a helicopter. Let's think. An example I like is the government offers to buy everybody's worst pair of shoes for £1,000. So we all hand in our worst pair of shoes, our oldest pair of shoes. We all have £1,000 in our bank account. We therefore there's an increase in the quantity of money. We didn't want to have that money relative to our income and spending before. So we try and spend it. Okay, I spend it. That reduces the quantity of money, doesn't it? No, it doesn't, because it goes to another bank account. All right? How does the whole economy revert to the previous equilibrium, the previous ratio of money to GDP? Through prices rising. The excess money creates this excess demand for goods. Excess supply of money creates an excess demand for goods, which can only be eliminated through transactions between people. The critical line here is that transactions between non-bank money holders, no matter how large they are, cannot change the quantity of money because they're just transacting between themselves. People think when they spend some money, it goes out of the economy. No, it's just going round and round and round. An equilibrium is defined by this desired ratio of money to GDP. All right? This is, in the book, I refer to Wicksell, who was probably the key guy making the distinction between the individual thinks he can reduce his money, therefore reduce total money. And in the aggregate, no, you can't do it that way. The only way quantity of money can change is a transaction between the non-bank money holders and the banking system. And then here the government's a special bit because the government's money balance is excluded from the quantity of money. So it's transactions between the non-bank money holders, them, and the banking system and the government. Those transactions between the non-bank private sector and the government and the public sector do change the quantity of money, but only then.
So it seems like there's another interesting.
I'm sorry, this is very hard.
Another interesting twist. To the way you describe the transmission mechanism. And perhaps I'm misunderstanding, you can tell me if I am, but it seems like there are two phases to it in your formulation. The first one is that the change in the quantity of money impacts asset prices. Okay. So it sounds like effectively people have too much cash relative to other assets that they want to hold. Yeah. So they'll put that excess cash into, I think you call them income variable assets.
Variable income assets, yes.
Variable income assets. Yeah. Equities, housing. Yeah. Those prices get bid up. Yeah. Then there's kind of a wealth effect from that. People's expenditure rises later.
What I do in the book is I have one chapter on the direct effect, which actually is it works as if in a sort of tropical island without any stock market or any houses or anything, and it's just as it were between money and say price of fish or something. Okay, and that's the direct effect in the goods market, and then there's this indirect effect working through asset markets. The general theory, the only asset's bonds, which is absurd. So what I say in the book is that there's a jump in the quantity of money. It's going to affect asset markets and the goods market. But what we see in the real world is that it tends to affect asset markets first. So this, to many people, astonished people, but in April, May, June 2020, I was expecting a strong stock market and a strong housing market. This COVID. Why? Because the quantity of money is just jumped by this amount, all right? Obviously, it's quite valuable information. And this is what I spent much of my career doing in the City of London. This is simply how the world works. You see, if you think about much of modern industry, there's an increase in demand. It's met from inventory, first of all. It's met from the stocks. It isn't met by a change in prices. the labour market is actually trying to run the economy for the labour market is completely crazy. It's so lagged that the labour market picks up things after the. So the labour market's lagged, wages are lagged, and the first effect of these money shocks, not just, by the way, in this cycle, but also in the Heath Barber episode, the Lawson episode, was a lot of asset price inflation first. Say 1986, for example, a lot of house prices were blazing away. And that was before, the peak in inflation was 1990. And in this cycle too, we had, the very strong stock market through, particularly those, March collapse, COVID. And then these late March, these huge increased quantity of money, which I was watching, Bill of Gloucestershire. And then the stock market stabilizes in April. And then April through to kind of, in a way, April 22, or early 2022, is very strong stock market. Then they tightened monetary policy. And in fact, from 2 years from March, April 2022, money stock didn't change at all in the US. All right. Yeah. First of all, the stock market goes down. I know it's been strong recently, but the stock market goes down. So the different parts of the economy react in different ways to these. I think what I would, just to summarize it all, that generally asset markets move first. Bond markets, by the way, are a wild card. The important markets are housing and equities, and in all of these cycles, you see these big movements in, this was true of this cycle as well.
Right. All right. 2 final short questions for me, and then we'll go to the audience. The first one is, if you, Tim Congdon, were in charge of monetary policy, how do you think it should be operated? There's a passing reference in the book to Milton Friedman's constant money growth rule. But you say that's a much bigger discussion. Do you favour something like that if you have the appropriate all-inclusive broad measure of money?
Completely unreformed. I'm an unreformed Thatcherite monetarist. I believe in money supply targets. Not changing my mind. Look, every society has a quantity of money. Every society has a price level. Thinking about societies since the beginning of civilization, as it were. There'll be a relationship between these two things. If you want to control inflation, we have to control the quantity of money. There's no choice about it. Now, I know that there were these problems in the 1980s. Sorry, they don't make any difference. Those basic points remain, all right? No, I do agree with Friedman, absolutely, yes.
All right. And then finally, looking ahead, I sense you don't think that central banks have learned their lesson. Nor is the...
Can I just say on this front that they haven't. I used to advise big financial institutions about Lombard Street Research. I was also a stockbroker. And what I would tell them now is, if you think that you can trust central banks to keep inflation at 2% for the next 30 or 40 years, you're balmy. We live in these mass democracies. They've been around for 100 years. You look at their record of controlling inflation, it's very poor. And I don't know if we'll go through something like the 70s again, but I really wouldn't rule it out. I mean, the runaway growth at the moment of US public debt, we're sort of middle of the pack, but also we've got lots of problems. France, again, the public debt is not under control. Right. And yet then you see the yields on the government bonds. They're just inviting, rape. The savers just going to lose the lot. As happened, by the way. I mean, I started work in the city in October 1976. And I worked out the real return, or rather the real destruction of return, destruction of value, on war loan from the previous 30 years, really, the end of the Second World War. And essentially, the inflation pushed up interest rates and bond yields, so the nominal value of bonds had gone down, and then inflation had reduced their real value. So the value of war loan at the end of 1976 in real terms was less than 4% what it had been 30 years earlier, and that is in Britain. We're supposed to regard ourselves as a stable, advanced country, and the rest of it, that was in Britain. So obviously that was an extreme, but it was horrifying that in 2020 you had yields on government bonds in 10-year area in Britain and elsewhere of less than 1%. They were just inviting, and in fact, of course, they've lost a lot of money.
All right, well, I didn't think we'd get a cheery note to go to the audience on.
Okay.
But yes, over to the audience. The hand went straight up in the front row, sir.
Very interesting. If you were on the beach in John Reed, and John Reed said to you,
Microphone coming, Corey.
Professor Congdon, thank you very much indeed for the lecture. It was wonderful. If you were on the beach with John Reed, and John Reed said, I have to keep on dancing to the interest rate cycle, how would you control the behavior of banks when you want to control broad monetary aggregates? Because the incentive of banks to lend at low interest rates is to lend as much as possible to as many people as possible, and try then to have correlation and diversification ameliorate the credit effects of the later bust. What would you say to John Reed?
You're thinking, is this a Citibank, is it?
Yes.
What the central bank should do is, yes, they do need to look at individual institutions. I'll come back to that in a second.
But just the banking sector in total.
Banking sector in total, you've got the data for new bank lending each month, and if the bank lending total is rising too rapidly, so it's going to cause money growth of say 8, 9, 10%, then interest rates must go up. I much prefer doing it that way to doing interference with loan decisions, imposing capital rules, and so on. So interest rates go up, and of course, in the first 40 or so years, the first 30 or so years after the Second World War, British banks could just receive an edict from the Bank of England: you can't lend at all. All right, and I don't think that's right either. I'm sure you don't. I have. So that's the answer to excessive growth of lending for. But then let's say you have one institution which is growing rapidly. Now, it's a good thing if it's competing hard for business. And if it's very profitable, and if it's got the capital to justify the growth of the balance sheet, and it's also can fund itself appropriately, fine. If you're in the central bank and you see this institution and you see it can't fund itself, hasn't got capital, sorry, you better behave yourself, because when we get to trouble, we won't lend to you. Oh, by the way, that subsidiary's got a license, we can take that. And of course, these conversations do go on. And in my view, for example, Fred the Shred should have been ticked off years earlier.
Can we have one first, and then the gentleman just behind you? Both behind you, in fact, yeah.
Thank you, too. Say that you are appointed the governor of the Bank of England, and you apply these monetary principles. Mm-hmm. How would those help to enhance the accountability of the Bank of England? Because in my view, it's been appalling. They haven't really acknowledged their mistakes in the recent inflationary cycle. Thank you.
Well, I think that's a very good question, because see, the Bank of England is subject to statute, and it has to answer to Parliament in two ways. There's the House of Lords Economic Affairs Committee, and then there's the I think it's called the Treasury and Civil Service, whatever it's called now, but that's where the Bank of England goes to be examined, as it were. And can I just say, and this is again quite important, that a lot does depend upon the quality of the people in these committees in Parliament. And one of the problems in the last few years is that the House of Commons one hasn't been very good. The House of Lords has been excellent. But anyway, so I think there are there's the parliamentary constraint, and then there's the media. I think what's happened in this cycle is the media has generally been pretty good. But ultimately, if the Bank of England, Andrew Bailey, decides he won't pay any attention to the criticisms that you and I have made, well, what can we do? I mean, we obviously, publish pamphlets through the IEA, write books, write articles in newspapers. Sooner or later there are effects. Otherwise, but of course it is in a way very dispiriting one. I disagree. I agree with you.
But Tim, Todd, may I just very short?
Sure, yeah.
Promise. But at least having those monetary targets will help us monitor the performance of
Well,
the bank.
indeed it would. And one of the things that, since I seem to have lost the case for monetary targets, I have suggested a system. This is actually not this one, but I have it put on people's chairs, something else I wrote last year for Voltaire. The system where, as part of the open letter arrangement, if money growth was very high, I think say over 8% a year annualized for more than 6 months, or if it was very low, then this could be seen in the data, and then there needed to be an open letter from the governor to the chancellor, to the world in effect. The rapid money growth won't lead to inflation, the slow money growth won't lead to deflation, and then we check. 6 months, 18 months later. I think some people noticed what I recommended but
questions fallacies as far as if you saw The Wizard of Oz, it was based on the banks the gold standard, and I wonder how much is Jerome Powell that the Wizard of Oz and all of us in the city think, hey, if Jerome Powell just drops interest rates, all of a sudden inflation will go away. Whereas we know inflation is caused by the war in the Ukraine and Russia, and there's not a one-to-one relationship.
No, it's not.
So I would like to know, so then what do you think is a relationship as far as correlation between interest rates and inflation? Is a one-to-one? What's happened to economic theory? And more about, we are going off the gold standard, at least some countries are going back onto the gold standard, and the impact then to the quantity of money.
Very interesting. Thank you. And the chap right at the back, and then Tim.
I guess work out what that was all about.
Thanks. At first, I wanted to thank you for your great speech. My question is about the limitations that we can put on government in creating money from thin air. And great economists like Buchanan and Milton Friedman that you said, they usually offer the idea of a constitutional limits. But Hayek believed in the type of limitations from industry, like a type of competition between currencies, that government in this competition cannot create a lot of money because its money will lose value. I think, what do you think about these type of ideas like Hayek ideas, or the type of more radical ideas like gold standards? Can they work in the real world? Thanks.
Mm-hmm. So I suppose the combined things there, actually, it's the seeming death or decline of economic theory, and the theoretical foundation to the way monetary policy is conducted. And then also, I suppose, more radical manifestations of that theory, whether it's Hayek's denationalization of money or some return to a commodity standard. Are these things that you're interested in?
Look, can I just pick up the lady's question?
Yeah,
I'm not quite sure what it's all about, but I think it's interesting saying that this is all, what I'm saying is very theoretical. It isn't. I've been active in financial markets and so on for decades, and had to advise large financial institutions and so on. And by the way, the low level of interest rates in 2021, even early 22, was the most fabulous opportunity to make money, just to go short of the interest rate contracts. Anyway, never mind that. Trying to understand the movements of inflation from current events, the Ukraine war, is in a way exactly what the problem is. It will always be the case that when you analyze the movement in price, it can be explained by the movement in some costs. That will always be true. But the costs are other kinds of prices. In a way, it's not really explaining anything. It's trying to explain prices. Inflation is rising prices. Inflation is rising costs. That doesn't really help you. That's why you must have some decent theory, and that's the point of the quantitative theory of money. There's a question about Hayek.
Yes. Well, you've told me about this before. Go on.
I have, free market economics It's a very big church, okay, very, very... And in monetary economics, I've had for decades these debates with the monetary-based people, with the M1 people, and so on. Okay, that's part of it. For the moment, I appear to be winning the debate, but who knows? Then there's the Austrian people. God, what a distraction. Look, crypto is a world. The only practical crypto is an example of Hayek's private monies, and I can see why it serves a purpose in places like Somalia and Nigeria and so on, where the state is unpredictable. And sorry if I upset people by saying that, but it's true. One would hope in a properly governed country that the value of money is stable. One would hope that. One would hope the government doesn't steal from you. One would hope that the bank doesn't steal from you, and so on. So you don't need crypto at all. So I have written about Hayek, and I wrote a piece as a very young man. I was 30, basically just rubbishing private money issuance. There's much more to say, but to me, why have I had so much trouble? And one of the beauties of the last few years is, God, it's been a cinch and I've been right. But the trouble is the monetary-based people, the narrow money people, the Hayek with his denationalism money, which was never going to happen. Oh.
All right. The cluster of questions here, if we can just bring the microphone forward. And if we could take the three, let's try and make them, if we can, quite short and pithy. So the two gentlemen there and then in front. Yep.
Hi, Paul Bayes is my name. Just a quick question on your comment about monetarism being rubbished at universities when Milton Friedman in 1981, in response to Neil Kinnock, as a part of Free to Choose documentary, said that monetarism is purely an economic concept, has nothing to do with politics. That's all. I'd like to expand, if possible.
Very interesting.
No, I don't agree with that. And this subject is saturated with politics. And Friedman did make some statements. I'm very curious, really. It's very clear that I need two points, really. One is that it does tend to be the case that economists who are supporters of the free market are also interested in monetary economics. This can't be disputed. You just can go through a list of economists and see what they say. The other illustration I want to give, which is very topical, is that monetary policy works through the private sector. In that sense, it's very discriminatory. You see, the government, a very special kind of economic agent, it doesn't need to hold a big money balance because its creditworthiness in its own borders is limitless in a sense. You can always, tax or print money. So this means that the control of public sector inflation and public sector unions and the possible impact of their wages on wider wage levels, that's not what the Bank of England can control. There is, therefore, what I call a kind of public sector problem. Now, curiously, I did actually mention this, my first thing I wrote, 1978, Monetarism Incentive Definition, just pointed out that the government's all this expenditure and its balance at the Bank of England is tiny. In Britain, historically, this has been a very important. So, what would I then say about the kind of society I want to live in? I want education and health privatized. Of course it's saturated with politics. Of course it is.
And the other two questions, Christopher, and then chap in the waistcoat there.
In 1959, I was taken on holiday to Switzerland, and my father told me that we got 12 Swiss francs to the pound. Today, you can get 1.1 Swiss francs per pound. Can we learn something from the way the Swiss run their economy?
Yeah.
Actually, Tim, can we take the other question as well?
Right.
Try and bundle them together.
Just a quick one. I'm from Ghana, and the economic hardship in the country has become severe. and the government insists that it is the cause of the war in Ukraine. But when my colleague at the back was did mention about Ukraine, we did rubbish it because it's been blamed that the war in Ukraine is the cause why the economic impact in my country has become so severe. But I'm still not convinced because we do have the IMF, yes, which monitors the monetary aspect in the whole world. So if the Western world economies are doing better, why is it not affecting that we are in Africa? Thank you.
Interesting. All right. So the Swiss question, and then I suppose about, is it economic mismanagement in some developing countries, or are they being affected by outside forces?
Okay. Well, I'm going to run away rather boring. I mean, the Swiss, they have a national bank, but I think is effectively private. It's not really, and they have restricted the growth of money. I'm not an expert on the Swiss monetary system, but they if you were to get the data, I can get the data if you like, and get it. It's actually in the IMF database. You'd see that since 1960, Swiss money growth would have been a fraction of that in the UK, and that is the dominant explanation for the fact that the pound's worth much less. It's just supply and demand. That there's been too many apples, pound sterling, created relative to the lemons, which is the Swiss franc. Sorry?
Quite good support for your views on...
Oh, yes. I in fact, once I get the data out, just check. But the question, I have some different... I'm sorry if you think I rubbished your colleague, didn't mean to do so. China and India have money. They have central banks. In this episode, they didn't change their money growth at all. It weren't like the Federal Reserve, the European Central Bank, or the Bank of England, or the Reserve Bank of Australia, or whatever. They didn't change money growth at all. And what happened to inflation in China and India? It didn't change at all either. All right?
That's because they got cheap oil from Russia.
I'm sorry?
They got cheap oil from Russia. So they're caught.
You can believe that, and then we will, and indeed there are economists who believe that kind of thing, and sure, we'll then occasionally get these crazy periods of excessive money growth and rapid inflation. It's exactly that kind of thing that then leads to say, what we must do is subsidize energy prices, or we must control prices. And no, the answer is to control the quantity of money. That's the right answer.
All right, we're running short on time. A cluster of questions over here. So 4 hands, really quick questions, please. I'm trying to wrap this one up in 5 minutes. So gentleman on the side there, and then we can go clockwise
around. Moving to the world gold standard.
Sorry?
Is the gold standard going to be reinstated again? It seems as if...
I'm not a gold standard freak, frankly, but... Shall I answer this or not?
If you could pass the microphone forward, and then while it's moving, Tim, you can answer that one quickly.
All right. Okay.
Go ahead.
I think humanity is intelligent, please. We're able animals. So we have a problem of social organization we should deal with in the best way. And to me, the gold standard's not the best way. The best way is to manage the quantity of money, as I've explained. What I cannot dispute is that the control of price doubles in most countries was better before 1971 in the post-war period, and that Britain left the gold standard in 1931. If you look at the British price double, say from 1700 through to 1931, it's basically stable, and they look at it since and it's doing that. I can't dispute that. So we should be intelligent, capable, we should deal with these social problems, shouldn't we? In practice, we've been useless.
In the front row, and then 2 questions over there by the window to round us off.
You say that you're the only, the monetary sort of economists, the only ones who have predicted the inflation. But there are other economists such as Larry Summers and Mohammed Al-Arian who have also predicted the inflation for different reasons, like, for example, labour markets and supply chains. Considering that they, like you, got it right, do you have any respect for their approaches towards predicting inflation?
I don't know what Mohammed Al-Arian has said. As far as Larry said,
It was more to do with supply chains at the end of COVID becoming more.
as far as Summers is concerned, Summers said nothing in spring of 2020. He started to forecast inflation in spring of 2021 as a comment on Biden's fiscal policy. And if you wish, this is what the debate is about. I'm well aware of these guys, and I'm sorry, no. I have actually. I wrote a letter to Robert Colville. You were there.
I was there.
You were there, yeah. And you saw the letter.
Yes.
Yeah. Where then I wrote a letter because this was raised. Didn't Larry Summers get it right? And they said no, he didn't. And I then went through it and the rest of it. And this letter was copied to Larry Summers. Where I explained why he was late, got the wrong arguments, etc., etc. Have I had a reply from Professor Summers? No. None of these guys are going to reply. I guess, you people in this room, if you think this is pretty contemptible, it is.
And the two questions by the window, please.
Oh, thank you.
And I know that's on the record, and I'm very pleased to have it on the record too.
Thank you. Federal Reserve, European Central Bank, Bank of England, they all pressed down their interest rate. The inflation recently has come down.
Yeah.
I'm wondering, would that also pick up the labour market demand? And whether the Phillips curve will still functioning in today's economy.
And then the lady just behind you.
Hi, sorry, I'll try to keep it to a short way. Thank you so much for your talk. So what I'm trying to say is the central bank objective is to protect the value of sovereign cash and currency. Hence, the cause of inflation could hardly be considered even a secondary objective, but getting it down is, and the mechanisms of this are plenty. The central bank almost had their hands tied to lend to government as they needed to spend to cover costs of COVID. And because they need to be neutral economists, they're not able to openly disagree or even have the luxury we have today to voice their opinion of the effects of increasing quantity of money. Given that central bankers have become the rock star of macroeconomics, has our profession become overly politicized? And is it in our best interest to keep these institutions in good standing? Don't you think the cost of rubbishing these institutions outweigh the benefits, as a drop in the trust of this institution could be far more catastrophic than beneficial?
Very interesting. So I guess it's a question about, well, firstly, the reputation of central banks and its importance, but also, I guess, about fiscal dominance and whether central banks really working to support government's fiscal objectives has been a big part of this problem. And then is the Phillips curve still relevant today?
Okay. As I explained in my talk, the most modern economists, certainly the dominant kind of people, if you like, they want to explain inflation about the labour market. And that's what then led to the Clougherty statement that this thing could go on for years and there'd be disinflation for years because of the big jump in American unemployment. Well, personally, I try and deal with that by looking at labour shortage questions and answers to those in business surveys. I don't really look at unemployment figures. By sort of middle of 2021, it was clear that there were severe labour shortages all over the place. And that was part of this, and there was too much money being created. It initially affected asset prices, then it affected goods markets and so on. So it will always be the case that there'll be a cost explanation working via the labour market, which is correct in retrospect. But can I just, using that approach, didn't enable you to forecast this at all. Can I also just say economists have got, they talk about the Phillips curve, then they talk about vertical Phillips curve, which is rather odd. Then there are other periods they talk about a horizontal Phillips curve. And I've even sort of a Phillips curve that does this. I forget how it was characterized. Well, oh my word, what a mess. Anyway, so what was the second question about politicization?
Politicization, fiscal dominance.
Ultimately, if you have a rascal as Prime Minister and the Finance Minister, and they overrule the central bank, none of these constraints will work. I mean, in a way, the purpose of these public debates is to raise issues so that people are aware of the relevant landmarks, and then, when we see things like in Mexico at the moment, where clearly the regime is losing, it's going in a very, then it affects the exchange rate and so on, and Mexico did a good job for a long time. It's such a tragedy, and so yes, these things ultimately are all political. And whoever's ultimately in charge of the army can determine these things. It's a wider conversation.
All right. On that note, Tim, thank you so much for the book, for the conversation this evening. I think it's been extremely enlightening.